and welcome to the program. This is the Money Show, reaching you from Nigeria's capital, Abuja. I am Nancy. Today on the program, where can I start from? I did tell you on Monday that the Monetary Policy Committee of the Central Bank of Nigeria, of course, started meeting on Monday and ended their meeting yesterday, two-day policy meeting. And of course, that committee decides on interest rates, cash reserve requirement, as well as the liquidity ratio. Yesterday, the governor of the central bank, Godwin Emefiele, did announce the rates and of course the decisions. Some of us were there at the central bank headquarters. Of course, that meeting is a very crucial one. It's a decision-setting a committee, and of course the MPC did raise interest rates yesterday by 200 basis points from 12% to 14%. And of course, not just raising rates, but the central bank governor did speak on a number of issues: external development, monetary development, as well as the domestic conditions in the country. Today on the program, I will be looking at that. What's the rationale behind raising interest rates in a recession? Some of us did not expect that decision, that the interest rate was going to be raised. A lot of analysts had predicted that it would be on hold at 12%. That's talking about the interest rate. But the central bank, NPC, did say, we are raising rates 14%. It's to maintain price stability, which is a core mandate of the central bank. But how do you tame inflation against spurring growth? A delicate balance at that. Anyway, the director of the Monetary Policy Committee, Monetary Policy Department of the Central Bank of Nigeria will be joining me. Moses Tule, in a short while, we will be looking at that, and I'll be asking him those fundamental questions. In case you want to join us, please go to Twitter. My handle on Twitter is @NancyLo. Find, follow, and drop your comment right about now. But let's quickly take you through the decisions as announced by the central bank governor yesterday, Godwin Emefiele.
The MPC, recognizing that the bank lacked the instruments required to directly jumpstart growth and being mindful not to calibrate its instrument in such a manner as to undermine its primary mandate and financial system stability, in assessment of the relevant issues, was of the view that the balance of risks remains tilted against price stability. Consequently, 5 members voted to raise monetary policy rate, while 3 voted to hold position. In summary, the MPC voted 1. To increase MPR by 200 basis points from 12% to 14%. 2. Retain the CRR at 22.5%. 3. Retain the liquidity ratio at 30%. And 4. Retain the asymmetric window at plus 200 basis points and minus 500 basis points around the MPR.
All right, that was the central bank governor, Godwin Emefiele. Of course, he announced the decisions yesterday. Let's quickly take a break, and when we come back from the break, of course, my guest will be joining me, Moses Tule. We will also bring you excerpts from the meeting yesterday, where, of course, the central bank governor answered questions from journalists, of course, talking about the new FX regime and all of that. All that we will bring in you after this break, but don't forget to join us. You can find us on Facebook at ABC Money Show Live. You can also find me on Twitter at NancyLo. Find, follow, and drop your comments. You can also watch the program on YouTube. In fact, you can also see past episodes, so go to YouTube, AIT Money Show, and subscribe, and definitely you get to see past episodes. Let's quickly take a break. We'll be right back. All right, welcome back. In case you're just joining us, it's the Money Show. Of course, my guest is joining me right now, Moses Tule, who is the Director of Monetary Policy Department at the Central Bank of Nigeria. Of course, Mr. Tule comes up, you know, sometimes on the show. So send your tweet right about now. Any question you want to ask Mr. Tule, please do that right now. I did say at the beginning of the program that the Central Bank of Nigeria's MPC did raise interest rate from 12% to 14% yesterday after the two-day policy meeting that started on Monday and ended yesterday. Many analysts were quite surprised. The surprising thing there is that, of course, Nigeria is in a recession. Technical, what kind of, we're in a recession, you know, and where do you hang the balance? Is it fighting inflation or moving for growth? Mr. Tule, welcome to the program. Thanks for being here again.
It's a pleasure, Nancy. Thank you so much.
How you doing the morning after? Because the morning after the decision announcement, how you doing? Was the feedback, you know, what kind of calls did you get and all of that?
Oh, yeah. It's quite, I must say, the morning after the MPC is pleasant. We can only be grateful to God. And of course, you expect that there will be feedbacks from across the broad spectrum of the financial market and the key stakeholders in the economy. Certainly, the decision of the MPC yesterday has been eliciting some reactions broadly. So,
what kind of reactions? Is it positive or negative reactions?
Yeah, it all depends on which side of the coin you are. Some felt that the decisions of the MPC were just right, and others feel that the MPC should have decided otherwise. So it's it all depends on where you are.
It's a difficult time, isn't it, Mr. Tule? It's a difficult time because even the central bank governor did say yesterday, of course, when he was looking at the rationale, assessing the domestic conditions in the country as against external development and all of that. He did say, of course, ensuring price stability is key as well as ensuring growth. But how do you now maintain the balance? Because, you know, for some people, after yesterday's meeting, they were quite surprised. A lot of analysts did expect the MPR would be held steady at 12%. And of course, the MPR is the monetary policy rate. What do you think?
Yeah, first of all, thank you so much, Nancy. I must agree with you that it's a difficult time, not just for the MPC, but for the whole world. The times are completely very difficult times globally. Beginning with the difficult times, the growth that had picked up in the United States has begun to taper. So you really don't even have any country on earth providing the growth impetus that will stir the demand, either aggregate demand, country level, or that will stir global demand. In the euro area, the entire region has not been able to come out of the global financial crisis of 2007, 2008. They've been teetering, and so they have a whole lot of issues. They are growing far below their growth potential. That's the euro area economies. The UK was just one good shining example, perhaps because it does not come under the European Monetary Union. It was having its own monetary policy, and so could take some very decisive UK-centric policies. Now, but with the Brexit, you have an entirely new ball game. China, that was a shining star quite a number of years ago. The infrastructure in China has come to maturity, and China needs to invest heavily in new infrastructure that will spur the kind of growth that China experienced, double-digit growth that it had experienced. And China was the anchor that drove growth in emerging market economies and in developing countries generally, because with the kind of growth that was going on in China, there was this huge demand for raw materials globally. And so, and with China down, Japan just teetering, not even been coming out of its own recession yet, and India is not here, it's not there. Certainly, the times are extremely hard. And then for the emerging market economies in particular, you have this problem with commodity prices. So whether you are an exporter of copper or you're an exporter of gold or you're an exporter of oil, you have problems there with commodity prices. Now, as a country, Nigeria happens to be an exporter of oil. And then we have our crisis with oil. Now, domestically, we have the blowing up of oil pipelines and vandalism of oil installations. And now that's a key issue. All these factors put together feed into the macroeconomy. Monetary policy cannot act in isolation. So when monetary policy is looking at the macroeconomic environment, it takes into account the international environment that has its own impact. Because, for instance, the Brexit vote impacted the global financial markets entirely. We were also affected. And so it's not just that one country, for instance, the destruction of oil facilities affected the global oil market. Oil prices began to go up. So that's the kind of quagmire we are in. So at the time oil prices began to go up because there were disruptions in Nigeria and in Iran, we were not in a position to reap those benefits because we were maybe exporting about 800,000 barrels per day instead of the 2.2, which is in the budget. So if we put the whole of that environment together, and in the build up to the MPC that ended yesterday, there are a whole lot of legacy issues that came up before the MPC, the July MPC. And part of those legacy issues were that, first of all, we had an abhorring growth figures that came out in the first quarter. There was an acute shortage of foreign exchange, and that was quite understandable. There are these 41 items that were excluded from access to foreign exchange because as a country we are not earning enough foreign exchange at the time when oil prices are extremely down there. And then the central bank was working on a framework that will be introduced in the market. So there was that shortage of foreign exchange. There was critical shortage of petroleum products, which built its own inertia for higher prices in the future. Then there was the crisis in the power sector. Power was not there, very erratic. And then you had the reforms. As part of the reforms, you had new tariffs in that place. Then we had the impact of the foreign exchange policy on the importation of food, because we felt there was a need for Nigerians to produce the food they would consume instead of depending on imported food. So with the absence of imported food, there was that shock. And then the food that was coming in from outside the country came in at higher prices. All this built up to the July MPC. So those were the kind of issues we're confronted with.
It's a difficult one. So how do you actually now navigate this landscape? Because at the end of the day, one will begin to ask, especially after the decision yesterday by the MPC, that how much economic sense does it take to fight, or does it make that you fight inflation that is at 16.5% as released by the National Bureau of Statistics for the month of June, as against growth? The country is in a recession. How much economic sense does it make that interest rates should be raised when the country is in a technical recession?
Okay, I think we need to provide Nigerians with a little bit of the hindsight, the benefits of hindsight, of looking at both sides of the coin. If you are pro-growth, you say, okay, look, So Nigeria is not just in a recession. Let's get that first clear. What we are in is not even a stagnation, not even a stagflation.
A stagflation?
It's not even a stagflation.
Why did you say we're not in a stagflation?
Let me explain.
Okay.
In the stagflation, one, you have stagnant growth, and then you have rising prices.
Yes.
But in the case we are in, we have negative growth. We're already growing in negative territory. Growth is minus 0.36. And then you have prices rising. So that's the complexity of where we are. So if we are for growth, the argument would be that you need to put all your arsenals together to ensure that you restart growth before any other thing can come on board. So you would then be looking at the situation and say, okay, look, for instance, during the global financial crisis, there was a crisis that was affecting the stability of the global financial market, and then every other person threw every other thing overboard to ensure that they achieved price stability. That's the pro-growth argument. If you then look at the price stability argument, which is what the MPC took its decision to base its decision on yesterday, you will look at the fact that, first of all, at 16.6%.
At 16.5% inflation?
At
Okay, 16 points, yeah.
At 16.5%, your earnings of 1,000 naira, effectively, the only thing you have in your pocket is minus 1,600. I mean, minus 160. So effectively, if you are earning 1,000 naira a month, minus 160 of that,
of 160 naira 50 kobo.
or something like that you are earning, or if you are earning 100 naira, you've already lost 16 naira 50 kobo. Exactly. You've already lost 16 naira 50 kobo, even without going to the market, even without collecting the money from your employer yet, without collecting the money yet, the money has lost its value by 16 naira 50 kobo out of every 100 naira that you have.
That's significant.
Now that's significant. So for a central bank, now, let me give these other two examples. We had given these examples before. We've heard what inflation is doing to the economy of Venezuela. It's just terrible. The country is just almost, the economy is almost collapsing because of the impact of inflation. Then we look at Zimbabwe here in Africa. Then of course, we've heard about all the hyperinflation in Germany, World War II. Again, that was terrible. You have a situation where all your earnings, all that you earn, is just not capable of giving you a loaf of bread. So from what we've said now, if we're earning 100,000 naira a month and you've lost as much as 16,500 naira, even without collecting the money, that is what you've lost to inflation. So as a central bank, the key mandate of the central bank is to ensure that people do not lose their wages or their earnings like that. But the impact of inflation is even worse on fixed income earners. By fixed income earners, let's look at people who are pensioners, for instance. Let's just take pensioners. If a pensioner receives his total take home, maybe he retired maybe some 35 years ago, and he's still alive, and all that his pension is 1,000 naira. So before he collects the 1,000 naira, he has already lost 160 naira out of it. And if we allow inflation to move any further to 20 to 25, in fact, next door, in Ghana, for instance, inflation is 26%. So it puts a lot of pressure on the resources of the country and of the government, trying to maintain minimum services. So the key attack for a central bank would be inflation. Incidentally, looking at both policies, the central bank has to take decisions whether it is pro-growth or for to tackle or to achieve its price stability mandate. Now, looking at that holistically, we felt that if we cannot make the lives of Nigerians better by increasing their wages, let us first tackle what we can tackle. And in this case, let us not erode their purchasing power. So that is what essentially informed the MPC taking that decision, the preservation of the purchasing power of the average Nigerian. And I must say that the decision could have gone either way, depending on the balance of probabilities of the risk, weighing the risk element in both. Now, the other good thing about it is that the decision has the flip side of helping and is consistent with the flexible exchange rate regime which the central bank released, and the FX regime which the central bank released on the 20th of June this year, which is that having released that framework, you need monetary policy to back it up. And at the point of that meeting, the government was borrowing at 18%. But the MPR, which is the policy rate that is supposed to signal the direction of all other interest rates in the economy, was at 12%. Short-term interest rate were 34%. That is overnight rate. The short-term interest rate, for instance, you have the overnight rate, you have the 7-day rate, you have the 30-day, exactly like that. Now, taking the least one, which is the overnight rate, it was at 34%, which means if a bank gets into trouble, before it comes to central bank, it has to trade in the interbank. It has to go to another bank and say, look, I need to square my position in my books with the central bank, and I need an overnight facility. And that other bank will say, we can only give you at 34%. Do you understand?
Yes.
So there was a complete disconnect between the policy rate, which is supposed to drive the entire spectrum of interest rate in the economy, and every other interest rate in the economy. There was that disconnect. Now, with maximum lending rate at 26%, prime lending rate at 16%, short-term interest rate at 34%, TB rate at about 18%, the NPR lost its position as an anchor for every other
Has the NPR
interest rate.
recovered that?
And it has not recovered.
No, because
the implication,
there's still a disconnect.
The implication also is that with inflation at 16.5% and the NPR at 12%, you have negative real interest rate of 4.5%. There is no way anybody can bring in money into this country to come and invest in that kind of a situation.
With the NPR at 12%.
Let me also say this. Let me also say this. And with Treasury bill rate at 18%, at 18%, it makes a whole lot of sense for the banks to come to central bank, because the standing lending facility, that is the lender of last resort facility, which the central bank lends to banks when they are in trouble, is 200 basis points above the NPR, which makes it effective at 14%, which is still 400 basis points below the rate at the risk-free rate which the government is borrowing at 18%, which means it makes sense for the bank to even come and borrow from central bank at 14% and buy government debt instruments.
And make money.
That's it. And so the reasoning of the MPC was that you could close that gap, and in trying to close that gap, you provide a signal to everybody that, look, we are concerned about the erosion of the fixed income or the wealth of the Nigerian public, essentially. And then it would also attract maybe foreign private investment to come in. I mean,
foreign investors.
like portfolio investors could then look at what they are earning from that at 14%. It looks quite good for them. Again, they could then just bring in the kind of foreign exchange that we need now to stabilize the foreign exchange market. Because if you don't stabilize the foreign exchange market, and the issue is, if you increase domestic interest rate and you stabilize the foreign exchange market, then the naira appreciates. So whatever you are losing in terms of the interest on this side, you are gaining in terms of an appreciated naira on the other hand. And that's especially for people who are manufacturers that are importing.
Okay. I will take you up on a few things which you said. You said you gave the scenario when the MPR was 12%, but now the MPR is 14%. We still have inflation at 16.5%. So there's still negative interest rates. So to speak, 16.5% minus 14%, you have 2.5%. Isn't it? Good. So I will come to that. The other question is, with MPR that is at 14% now, the cost of lending from banks to manufacturers or from banks to those that need loans will be costlier, so to speak. But hold on your thoughts, Mr. Tule. You would answer that in a bit. And of course, in case you're watching and you want to contribute, you want to ask questions, please do that. I've seen a few questions on Twitter. My handle is at Nancy Los. Send your comments right about now. Let's quickly take the excerpts, of course, from the meeting yesterday at the central bank headquarters. Of course, the central bank governor, Godwin Emefiele, did announce the decisions, and he did answer some questions. Let's quickly bring you that now, where he answered questions on the new FX policy regime, the assessment of that. We did ask him that question. We also asked him the question concerning fighting inflation against spurring growth. And I also did ask him a question on the state of the banks in Nigeria, the health of banks, because a lot of questions have been coming to me concerning that. So I needed the central bank governor to answer that question. So let's take this excerpt, then we will come back. Don't forget to send your tweets.
A world where unemployment is decreasing daily, where GDP is rising and our economy is prospering in Nigeria. Our small and medium business have the potential to achieve this. Come and learn from some of the country's leading entrepreneurs at the Nigerian Small Business Summit, a two-day event in Lagos which gathers top financiers, policymakers, and successful businessmen and women. At the Nigerian Small Business Summit, you will understand how to structure your business for success based on best practices from Nigeria and India, in ways that trigger growth and create jobs. Come and get the push you need to propel your business to the next level at the Landmark Center, Victoria Island, Lagos, Wednesday 24th and Thursday 25th August 2016. Call 0818 803 9706 for more details. NSBS. Grow small business. Create jobs. Be there.
All right, well, sorry for that, but when it's ready, we would actually bring it to you on the screen. Okay, Mr. Tule, I did ask you a few questions. So how do you, the cost of lending right now will be more expensive as against inflation rate and the interest rates?
Yeah, thank you very much, Nancy. And that's exactly the essence of monetary policy. When the central bank takes a monetary policy decision, and that decision especially affects interest rate. If it raises interest rate as it did yesterday, the essence is to address inflationary pressures. Because the literature, the economic literature teaches that for quite a number of cases, inflation is a monetary phenomena. So by reducing the capacity of the banks to lend, by increasing interest rates, that is supposed to affect lending. But I wanted to know that even when interest rates were extremely low, there was a time the MPR was 6%. Banks in Nigeria were still not lending. Banks have had to sit on huge liquidity and not lending at all. From year to date, it is only the data we have in June that indicates that credit to the private sector rose by about 8% from year to date. All through the year, data has been 2%, is 3%.
So what made it rise? What was the reason for the rise?
We have to look at the underlying reasons for the rise. Of course, the economy is picking up. The economy is picking up. There has been so much credit going into agriculture. So that's part of it.
Is it from the monetary side or from the fiscal side? Because I know there's been interventions from the Central Bank of Nigeria?
Not just from the
Bank, for example.
Not just from the central bank, also from the banking system. There has been credit to agriculture has increased substantially. And if you look at food inflation in the month of June, for which data is available, dropped substantially. It's one of the highest that dropped, food inflation, indicating that some of the policies are already having a salutary effect on the system. So indeed, we do expect that an increase in interest rates, if the transmission mechanism is working correctly, and which I believe is working correctly, would translate into higher rates. But let's get this clear. Then there's a peculiar behavior of banks in the country. When the MPC reduces interest rates, banks are never in a hurry to reduce interest rate. And in most cases, they just leave interest rate at the level that they are.
It is.
But there are also instances that they actually do reduce after some time. But to say that if the cost of capital becomes higher and then they will still leave interest rate at the same level that they are, is not quite correct. Certainly, interest rates are expected to rise. But with credit to private sector, just growing at just at 8%. And government is not borrowing at all. The government borrowing is zero from the data that we have, from the banking, the banking system. So you see, the picture then becomes clear that you expect some slight upward adjustment in interest rate.
Okay, I'm being told now that the visuals are ready, but let me just take a few tweets before I do that. Odi Akedeli said, Nancy, increasing interest rates have increased in various economic effects. I guess that's what he wants to say. Increasing cost of borrowing. That's actually what I was asking earlier.
And that's exactly what I said.
Yeah. Okay. Augustine says growth of the domestic market, that of the international market, which is better. So perhaps he's actually of the view that MPC did raise interest rate to soothe portfolio investors or to soothe foreign investors.
That's not correct. That's not correct. We try to explain the key reasons, and I told you that that's the flip side. That's the flip side of it. That on the other hand, what could also come out of the increase in the interest rate is that it could also attract portfolio investment.
Okay. Iseta is saying raising MPR from 12% to 14% now means higher cost for businesses. Prices will move up and further make living standards worse. Is that it?
Yeah. Prices would move up. I don't understand. When we are trying to address inflation and we're trying to reduce the volume of currency in circulation, so where are prices going to rise? That's exactly the essence of raising interest rate in order to fight inflation.
No,
that's the economics.
Mr. Tule, the inflation that we have right now is not monetary induced, isn't it? It's structural induced. It's structurally driven. The 16.5% inflation that we have right now is structurally induced. Fuel prices are high, 145 a liter. I did hear that some petrol stations are selling lesser than that. Transportation costs higher and all of that. So how much sense does it make for you to use a monetary tool to fight a fiscal, a structural problem?
Yeah, Nancy, I think you are already an economist. I'd clearly underlined the legacy factors and did indicate that those were structural factors and not monetary phenomena. But you recall that when the budget was passed, at 300 and something billion or 60 billion or so was supposed to be injected into the economy for purposes of our capital, the capital budget. Remember, fiscal policy has been nearly absent from year to date because of the late passage of the budget and all the issues. Even after the passage of the budget, what is required to really get the money from the budget injected into the economy. And you should also remember that between now and end 2016, nothing less than about half of that budget is going to hit the economy. Just last week, the Honorable Minister for Finance indicated that we're going to borrow externally. There's been some borrowing that is going on domestically also. So if you put all that together, you will see that we are expecting huge injection of liquidity into this economy between now, this July, and July is already gone. So you're looking at August, September, October, November, December. That's about 4 months or 5 months or so.
So are we saying things are going to get better in the next few months of the year?
There's going to be a lot of liquidity in the system. That's
because of the budget.
That is the point that is being made.
Now the question is...
The budget hasn't impacted the system yet, but it is certainly going to impact the system.
The question also is that there's been no adequate coordination between the fiscal and monetary side. I was speaking with someone yesterday, of course, after the MPC. I spoke to a few people, even this morning, and they were of the view that we need more coordination between the monetary policy, which is the central bank, and the fiscal side, which is the federal government, finance and co. Now, what do you think? Are we seeing that synchronization? Because I do remember that even during our summit, the summit we held, we had in May, we did call for a synchronization. You were there, you gave your own lecture. Are we seeing that? Because it seems FG is on their own, CBN is on their own. Anything FG does, central bank is doing fire brigade. Oh yeah, let's quench the fire. Can we see a holistic plan from both organs?
That's why I'll beg to differ that there is no level of coordination. I would like to underscore the imperative for greater coordination. And the imperative is on the basis that in other jurisdictions, coordination between monetary and fiscal policy is by legislation. So they are compelled to sit down and discuss policy together. And the 20th anniversary, which you made reference to, where we made that presentation, we did put on the table that there is a need for the National Assembly to pass a law that compels the fiscal and monetary policy to sit down every quarter, and harmonize their policies, have frank discussions about macroeconomic management. You can't clap with one hand. Fiscal policy alone cannot run this economy. Monetary policy alone cannot run this economy. And you go to a house where the husband just says, I'm the head of the house, and the wife says, I'm the madam of the house. If the children would suffer, go to your daddy, go to your mommy, these children, you are disturbing me. You don't want that kind of a thing. So, but if the both of them understand why God has given them children and why they need to bring up these children in the way that they would honor God, they would have a framework for bringing up the children. So that whatever the mother says is the same thing the father has said. Whatever the father says is the same thing mother will say.
So we are saying, are we seeing that
so
framework
what we are saying is
by
that
both organs?
It has to be improved through legislation. A good piece of legislation, as is done in other countries, that compare the fiscal and monetary authorities to sit down around the table every quarter or every other month to harmonize macroeconomic policy would be best for this country. Okay. In that case, no one person can clap alone. No one person will think, I am more important than the other person.
All right, let's quickly take the excerpt now, and after that, we'll come back for your concluding remarks. If I can also take some questions from Twitter, because a lot of people are asking questions. Let's take the excerpt. We'll be back.
I'd like to say so far, so good, and I want to give an excellent assessment to say that it's been excellent so far, given that we had a 16 months period of, put it very clearly, no activity in the foreign exchange market. And I would say that the results has been good, with a few activities that we're not too happy about, but we feel that in the course of time, because this is just practically like just 1 month since this started, that there is still a lot of room for improvement, and I expect that these positive trends will be sustained. Why did the MPC decide to tilt towards inflation rather than growth? Basically, MPC decided to say, look, if we look at the balance between inflation and growth, that we should stay with growth and expecting that that growth, because the MPC, monetary authorities, cannot directly influence growth, giving the fiscal authorities the impetus to push forward on growth. But like I read in the communique, MPC members felt that that was still is coming in rather quite slowly. But at this meeting, you will also notice that we took a lot of time to deliberate as against inflation. We felt that there was a need, in line with central bank's core mandate, to look at price stability at the time. That if we favor price stability at this time, in which case signal an interest rate movement that will curtail inflation, that when we curtail inflation, a lot more stakeholders' interests would have been sort of met, thereby encouraging, in this case, inflow into the country. And as you have more inflow of foreign exchange into the country, what that does is that it deepens the FX supply base, and by deepening the FX supply base, it makes it easy, it makes foreign exchange available to end users, particularly to the manufacturing sectors who require raw materials to boost manufacturing and industrial capacity. And we're also hoping that when this is achieved, what you find is that naturally prices will be affected downwards. When you have a situation of structural inputs in it helps to boost the aggressivity, and this also helps to moderate the effect on prices downwards. So what this does is it generally creates activity that will boost not just manufacturing and agricultural output, but will indirectly now begin to push growth forward. That was purely the essence of saying, let's push from the direction of taking inflation and price stability as a focus during this meeting against growth. It didn't mean that we didn't have growth at the back of our mind, but we felt, let's start by looking at ultimately seeing how you can achieve growth in the same vein. What is the objective of selling FX to the BDCs? If you recall, in January, we said that the Central Bank of Nigeria could not continue to dip its hand into the scarce reserves to fund the operations of the BDCs, which is entirely cash. But we also said in that process that, look, that the BDCs are allowed to source their foreign exchange from autonomous sources. We went further to say that central bank market to be able to continue to do their business and provide a source of livelihood to those who are in that business. Unfortunately, I use the word unfortunately, it took us between January and June to do this. Now what we feel is that we all know the size of diaspora funds that flow into this country. And we thought that what we should do is that foreign currency that flows into the country
All right, welcome back. Of course, I guess tomorrow we would also take that, because the governor did answer many questions, especially also concerning state of banks and why the new measure to sell FX to BDCs. That's quite key, because I've been getting questions of that. All right, Mr. Tule is still here, the Director of Monetary Policy Department of the Central Bank. Just before we go, let me take a few comments coming. Monetary measure going ahead and addressing inflation in anticipation of fiscal policy will not be effective. That's from Tayo. Issa says, hike in MPR won't still attract foreign investors amid the precarious security situation in the country. While Fred says, how will this increase, how this increase in monetary policy will not further increase inflation again? I think you've answered that. So in closing, what do you have to say? Because Nigerians seem to be they're still not convinced that raising interest rates is the way out. especially in this difficult time? What's your concluding remarks?
Our concluding remark is that it's a policy that was well debated by the MPC and well thought out. The pros and cons of acting otherwise was also considered, and this was an informed decision of the MPC. Let me say that since 2007, when the global financial crisis struck, the countries in the euro area have not come out of the impact of that crisis yet. And the countries in the euro area are still in a recession, despite the unconventional monetary policy, which is an injection of over 500 billion euros into the economies of the euro area every month by the European Central Bank. The Bank of England injects over 300 billion pounds into that economy every month to ensure that the UK does not get into recession.
In fact, in Japan, I think Japan wants to inject 28 trillion yen by August 1.
That's correct. So, you see, what are the issues I'm looking at? We are expecting a huge injection of liquidity from the federal budget between now and the end of the year. We also did say that the current inflation trend is as a result of legacy factors that began perhaps sometime last year and have built up to the current levels, because there's always a lag in policies when you take the decisions. So thinking that the decision of the MPC today is going to increase prices, it will not increase prices. And if the federal budget, depending on the level of injection that gets into the economy between now and end year, the MPC may need to follow it up again with a further hike in interest rate, depending on the volume of liquidity from the federal budget that gets into the system. So if prices do rise, it is certainly not as a result of yesterday's decision. Yesterday's decision would only impact the macro. We would only see the data coming out about 6 months down the line, or maybe even about a year down the line. So it's not as if you take the decision today, tomorrow you go there and you see. No. It's not so.
I think we'll continue to monitor the discussion, but I think that's
fine.
We'll leave it at this point. Thank you, Mr. Tule, for coming, as always. Thank you very much, and let's see how it goes.
Thank you, Nancy.
All right, I've been speaking with Moses Tule, who is the Director Monetary Policy Department of the Central Bank of Nigeria, explaining the rationale behind raising interest rates yesterday from 12% to 14%. We'll continue to monitor the situation closely. Thank you very much for your tweets. Thank you for watching. Be the best you can be that change you also want to see. I am Nancy Ilo. God bless Nigeria. Bye now.